A family can be employed, careful, and still feel one ordinary bill away from panic. That is the American contradiction now. Paychecks arrive, but rent, food, insurance, childcare, medicine, debt, and transportation reach them first. This is not a claim that every household is collapsing. It is a look at 20 measurable warning signs showing how economic pressure is hollowing out stability. By the end of this video, you will see why official growth can coexist with shrinking grocery carts, delayed families, exhausted workers, and homes that no longer feel financially safe. The danger is not always visible in a foreclosure notice or an empty refrigerator. It often appears quietly: a minimum payment replacing a full payment, a repair postponed, a prescription stretched, or a parent calculating which bill can survive being late. That quiet damage matters because families do not break all at once. They absorb shocks. They cancel plans. They borrow. They work more. They lean on relatives. Then the coping methods become permanent, and a temporary squeeze turns into a way of life. The facts come from federal surveys, household debt records, housing research, and consumer protection findings. The point is not to create panic. It is to connect numbers usually reported separately, although real families experience them at the same kitchen table. Economic strength is often described through averages. Families live through sequences. A higher wage can be erased by a rent renewal, an insurance jump, a car repair, and 2 weeks of childcare. An average cannot show the order in which those blows arrive. So watch for the pattern beneath the headlines. The issue is not merely that things cost more. It is that more essential costs are becoming fixed, financed, data-driven, difficult to compare, and almost impossible to avoid. The Department of Agriculture estimated that more than 13% of households were food insecure at some point during 2024. Limited money disrupted access to enough food in a country with enormous food production. 18 million households is not a fringe. It includes workers, children, older adults, and people whose income looks acceptable until housing, transportation, and medical costs are deducted. Hunger is often hidden inside households that still have phones, cars, and jobs. Food insecurity does not always mean no food. It can mean cheaper food, fewer balanced meals, smaller portions, adults skipping meals so children can eat, or families waiting for payday while the refrigerator gets emptier. That is why a full supermarket parking lot proves very little. People may be shopping while trading nutrition for shelf life, fresh food for processed calories, or enough food for the whole week for whatever can survive the total at checkout. Grocery inflation can slow without grocery prices returning to where they were. A lower inflation rate means prices are rising more slowly, not that the old price tags are coming back. Families feel the accumulated level, not the latest monthly percentage. A household that once bought meat, fruit, snacks, and cleaning supplies may now buy the meal ingredients and postpone everything else. The receipt may look normal. The missing items are the evidence. When food becomes the flexible category, families cut it to protect rent, electricity, and the car needed for work. That is not budgeting success. It is a warning that the most basic human need has become the bill that must bend. The next sign is shrinkflation, but the truth is more precise than the slogan. A smaller package at roughly the same total price raises the price per ounce, sheet, load, or count. The shelf price may look stable while the household buys less. The Government Accountability Office found that downsizing contributed little to overall inflation because relatively few tracked products were affected. But it mattered more in categories such as cereal and household paper products, where families notice repeated replacement costs. Shrinkflation did not cause the whole inflation problem. Claiming that would be false. Yet calling it harmless would also be false, because subtle quantity cuts can make familiar products costlier without causing the same reaction as a visible price hike. Researchers reviewed by the government found that shoppers tend to respond less strongly to smaller packages than to equivalent price increases. The reason is obvious. People remember the price more easily than the old net weight, roll count, or number of servings. Packaging can preserve the same height, colors, and visual weight while reducing what is inside. A deeper bottle curve, a narrower box, or fewer sheets per roll is difficult to detect when a parent is shopping after work with children and a fixed budget. The defense is unit pricing, but even that can be frustrating. Stores may display different units for similar products, place the unit price in tiny type, or make sale tags visually louder than the number that allows a fair comparison. The ordinary shopper misses the change because attention is scarce. Economic pressure does not only reduce money, it reduces the time and mental energy needed to compare every ounce, coupon rule, package count, and expiration date. Another sign appears when a discount is no longer simply a discount. The lower price may require a loyalty account, an app, a digital coupon, or a purchase history. The customer pays with money, data, or both. Loyalty prices can genuinely save money. They can also divide the shelf into a public price and a member price, making the higher price feel like a penalty for shoppers who lack a smartphone, forget a password, resist tracking, or do not have time to activate an offer. The Federal Trade Commission has examined technology using location, browsing behavior, shopping history, and online actions to tailor prices, promotions, or product displays. It has not said every retailer does this. It has said the capability is real and expanding. That creates a disturbing possibility. The price environment may react to the customer. One shopper may see a different promotion, a different ranking, or a different sense of urgency than another. Comparison becomes harder when the marketplace is not showing everyone the same shelf. A loyalty program teaches the store what a household buys, what it avoids without a discount, and how quickly it returns. That data can improve offers, but also the seller's ability to measure how much resistance a price increase will meet. Personalized convenience can weaken shared price visibility. When shoppers receive different offers, families cannot easily compare what neighbors paid or know whether a deal is generous, ordinary, or designed specifically for them. Economic stress grows when a fair price requires constant digital participation. A parent should not need to scan a code, load 5 offers, surrender a purchase history, and solve a small puzzle simply to avoid overpaying for dinner. The store itself provides another warning. Grocery shopping is not arranged like a neutral warehouse. High-margin items receive attention. End displays create urgency. Eye-level placement reduces searching. Checkout lanes turn waiting time into one final chance to spend. None of that is illegal or mysterious. Retailers are trying to sell. The problem is that families under pressure often blame themselves for weak discipline while shopping inside an environment engineered to make the fast, visible, and emotionally appealing choice easier. Premium products add another layer. A package may promise protein, natural ingredients, convenience, wellness, or restaurant quality. Some claims reflect real differences. Others mainly justify a higher margin or polished story around ordinary ingredients. Private label products can cost less because the retailer controls the brand and marketing. But store brands are not automatically the best value. Package sizes, formulas, and sales cycles differ, so the cheapest sticker can still lose on unit price or usable quantity. Coupons can lower a planned purchase. They can also increase the total bill by rewarding extra quantity, steering shoppers toward a more expensive version, or creating fear that a deal will disappear. Saving $2 is not saving if the item was never needed. Convenience habits become expensive because they are reasonable. Pre-cut fruit, single-serve snacks, prepared meals, bottled drinks, and wrapped portions save time. For an exhausted household, time may feel scarcer than money until the card statement arrives. The result is not that families are foolish. It is that the market charges a premium for fatigue. The less time a household has to cook, compare, clip, plan, and travel, the more likely it is to pay extra for speed. That leads directly to delivery apps, where the visible menu price may be only the beginning. Item prices can differ from in-store prices. Service fees, delivery fees, small order charges, taxes, tips, and other costs can appear across several screens. The Federal Trade Commission has asked whether online food and grocery platforms clearly disclose total prices, item markups, variable fees, personalized pricing, and promotion limits. That inquiry exists because comparison becomes distorted when the final cost arrives late. Delivery can be valuable for a disabled customer, a caregiver, a parent with a sick child, or a worker without reliable transportation. Calling it mere laziness ignores the people for whom delivery is access, not indulgence. But necessary convenience can become a tax on constraint. The household with the least time, mobility, or transportation may pay the highest effective price for the same bag of groceries. Subscriptions make the cost feel controlled by promising reduced delivery charges. Yet a subscription can encourage more frequent orders, and reduced delivery does not necessarily eliminate service fees, item markups, tips, or minimum purchase requirements. The app also separates spending from the physical cart. Adding one more item feels lighter on a screen. The buyer does not watch the basket fill, handle each product, or see the total until the habit of tapping has already done its work. When a family routinely finances convenience because the week leaves no other option, the problem is larger than a delivery fee. It is evidence that time poverty and money poverty are reinforcing each other. Housing is the next unmistakable sign. Millions of renters spend more than 30% of income on housing, the traditional threshold for being cost-burdened. Many spend more than half, leaving the rest of life to compete for what remains. Harvard housing researchers reported a record number of cost-burdened renter households, and especially severe pressure among renters with low incomes. For those families, one rent payment can consume the money needed for food, medicine, transportation, and savings. A rent increase does not have to be dramatic to destabilize a household. An extra amount every month is permanent. It repeats 12 times a year, then becomes the base from which the next increase is calculated. Moving is not a clean escape. Deposits, application fees, truck rental, time off work, utility transfers, school disruption, and the need to qualify for a new unit can make a cheaper apartment expensive to reach. That is why families double up. Adult siblings share rooms. Grandparents take in children. Couples stay together after a relationship has failed. Friends convert living rooms into sleeping space. The housing statistics call it a household arrangement. The people inside call it survival. New rental construction can rise while affordable supply still shrinks, because newly built units often enter at higher rents. A city may add apartments and still lose the lower-cost homes that service workers, retirees, and young families can actually afford. A housing market is economically destructive when shelter absorbs so much income that every other bill becomes a crisis. The family may technically be housed while becoming poorer each month. Homeownership offers no easy rescue. High prices and elevated mortgage rates can make the monthly payment on an ordinary house unreachable, even for buyers with stable jobs and responsible credit. A mortgage rate does more than change interest. It changes purchasing power. When borrowing costs rise, the same monthly budget buys less house, yet sellers may be reluctant to cut prices enough to restore affordability. Owners with older, lower-rate mortgages may stay put because moving would mean replacing cheap debt with expensive debt. That limits listings, traps some families in homes that no longer fit, and makes the market harder for first-time buyers to enter. The down payment is only the front gate. Closing costs, inspections, moving expenses, repairs, property taxes, insurance, and furnishing arrive around the same time. A family can qualify for the loan and still lack the cash buffer to own safely. Starter homes are also competing with investors, higher-income buyers, and households carrying equity from a previous home. The first-time buyer often enters with wages and savings alone, facing people who can convert an existing asset into a stronger offer. The cost is measured in delayed wealth. Renters miss the forced savings of principal payments and may watch home values rise faster than their down payment fund. The target moves while they save toward it. A society can praise ownership while building an entry price that excludes a growing share of working families. When stable employment no longer creates a realistic path to a modest home, the bargain has changed. Even families who already own a home are showing strain through insurance, taxes, and repairs. The mortgage payment may be fixed, but the true cost of ownership is not. Harvard housing research found sharp increases in property taxes and average insurance premiums over recent years. Those costs hit owners who thought they had locked-in housing stability, including retirees living on income that does not rise as quickly. The Federal Reserve found that some homeowners went without insurance, most commonly because of cost. Among insured owners, many said premiums had risen more than expected or that they could not afford as much coverage as they wanted. Going uninsured can look like a monthly saving until fire, wind, water, or another disaster destroys years of equity. Underinsuring creates a similar risk. The family owns an asset on paper but cannot fully rebuild it after a loss. Maintenance is the hidden bill that never stops. Roofs age, appliances fail, plumbing leaks, and heating systems quit. When cash is tight, owners postpone small fixes, and small fixes often become larger, more expensive failures. This is how an asset turns into a source of anxiety. The house may appreciate, but appreciation does not pay the repair technician unless the owner borrows against the home, sells it, or already has savings. Home ownership is supposed to create security. When taxes, insurance, and maintenance rise faster than household income, the home can become a valuable asset that its own family struggles to keep. Childcare is another sign because it can rival housing in the monthly budget. A parent may want to work, find a job, and then discover that the cost of care absorbs so much pay that employment barely improves the household's position. Childcare. Aware estimated a national average annual price above $13,000 for 2024. The average hides enormous local differences, but it shows why care is not a side expense. It is core economic infrastructure paid largely by families. For 2 children, center-based care can exceed annual rent or mortgage payments in many places. The burden arrives during the years when parents are often earning less than they will later, carrying student debt and trying to build savings. The provider is not necessarily getting rich. Childcare requires staff, space, insurance, food, supplies, training, and low child-to-adult ratios. Families pay too much while many workers earn too little. That is a broken market structure, not a simple case of greed. When care is unaffordable, one parent may reduce hours or leave work. The immediate budget may improve, but the family loses wages, promotions, retirement contributions, professional experience, and future Social Security earnings. Grandparents and relatives fill the gap, often without pay. That help can hold a family together, but it transfers the cost into another form. Lost time, physical strain, changed retirement plans, and dependence on a support network that not everyone has. A country is economically weakening its families when having children can force a choice between income and safe care. The pressure does not end when the child enters school. It simply changes into after-school costs, summer care, and schedule conflicts. Healthcare creates the next warning because insurance does not guarantee affordability. Premiums, deductibles, co-pays, coinsurance, uncovered services, and out-of-network bills can expose a family to costs it cannot predict before treatment. KFF estimated from government data that Americans owed at least $220 billion in medical debt. That estimate was based on earlier survey data, so it is not a live meter. It still reveals how often illness becomes a financing event. Medical debt is different from buying something optional. People rarely choose the timing of an injury, a diagnosis, or a child's fever. They enter the transaction under stress, with limited ability to compare prices or walk away. Families respond by delaying appointments, stretching medication, skipping dental work, or avoiding follow-up care. A postponed problem can become a more expensive problem, turning lack of cash today into worse health and higher costs tomorrow. Employer insurance can also make job loss doubly dangerous. Losing work may remove income and health coverage at the same moment, exactly when stress and medical vulnerability rise. Even a family with no medical debt may live cautiously because of the deductible. Savings that could support education, a home purchase, or retirement remain mentally reserved for the possibility that someone gets sick. An economy is not secure when treatment competes with rent. The medical system may deliver world-class care, but a family economically damaged by accessing it has not experienced financial protection. Emergency savings reveal how thin the margin has become. The Federal Reserve reported that fewer than 2/3 of adults could cover a hypothetical $400 expense entirely with cash or its equivalent. That means a routine shock can trigger borrowing, selling possessions, asking relatives, overdrawing an account, or simply not paying. $400 is not a catastrophic amount in the national economy. Inside a tight household, it can reorder the month. The same survey found that major unexpected expenses were common, especially vehicle repairs, home or appliance repairs, and medical costs. The emergency is not rare. The savings are. A family without a cushion pays more for the same problem. It may use a high-rate card, accept a costly payment plan, miss work while arranging money, or delay the repair until the damage grows. Savings are also harder to rebuild after prices rise. The household may keep the same disciplined habits, yet find that every leftover dollar is absorbed by a higher grocery total, utility bill, premium, or rent payment. This is why telling people to save more can sound insulting. Saving is essential, but advice does not create a surplus. A budget cannot allocate money that fixed costs have already taken. The warning is not that every family lacks savings. It is that a large share cannot absorb a modest shock without changing debt, consumption, or relationships. That is fragility hiding inside normal life. Credit cards provide the next sign. They are useful payment tools and can offer fraud protection or rewards. But when groceries, utilities, and repairs remain on the balance, the card becomes an extension of income that charges rent. The New York Federal Reserve reported credit card balances around $1.25 trillion in early 2026. Aggregate debt does not prove that every borrower is struggling, but delinquency and survey evidence show serious pressure among vulnerable households. The Federal Reserve found that many cardholders carried a balance during the prior year, and carrying balances was more common among lower and middle-income cardholders than among the highest income group. Interest changes the price of yesterday. A meal bought months ago can still be generating charges after the food is gone. Minimum payments keep the account current while stretching repayment and preserving the lender's interest income. Rewards create a strange split. Households that pay in full can collect points or cash back. Households that carry balances may pay interest far exceeding those rewards. The same product acts like a benefit for one customer and a drain for another. Credit limits can disguise declining affordability. The family still completes the purchase, so consumption appears stable. The damage moves from the checkout line to the balance sheet, where it becomes easier to ignore until the minimum payment rises. When basic living costs are routinely financed at high rates, debt is no longer funding a future asset. It is funding the gap between what life costs and what work pays. Transportation is another pressure point because most American communities require a car for work, school, groceries, and medical care. The vehicle is not merely a purchase. It is permission to participate in the local economy. Auto loan balances have climbed into the trillions, and younger borrowers have shown particular repayment stress. A missed payment risks more than a damaged credit score. Repossession can threaten the job that was supposed to make the payment possible. The sticker price is only one layer. Interest, insurance, fuel, registration, tires, maintenance, parking, tolls, and repairs turn transportation into a large fixed claim on income. Vehicle insurance can rise even when the driver has not had a crash, because repair costs, local losses, vehicle technology, theft risk, and broader pricing factors affect premiums. The household experiences the increase as a bill it cannot easily refuse. Modern cars may be safer and more capable, yet repairs can be expensive because sensors, cameras, electronics, and specialized parts are built into ordinary components. A minor collision can produce a bill that surprises the owner. Families cope by keeping older vehicles longer, postponing maintenance, accepting longer loan terms, or buying used cars with uncertain repair histories. Each solution lowers one cost while increasing another risk. Transportation. Poverty is time poverty. A failing car means missed shifts, expensive rides, long bus transfers, and fewer job choices. The family does not merely lose money, it loses options. Student debt is another sign because it turns education into a bill that can follow adulthood for decades. The borrower may earn more because of the education and still struggle with the timing and size of repayment. The New York Federal Reserve reported that serious delinquency on student loan balances rose after federal payment reporting resumed. In early 2026, more than one-tenth of balances were at least 90 days delinquent. Delinquency can lower credit scores and make apartments, auto loans, and other borrowing more expensive or harder to obtain. One education bill can therefore raise the price of unrelated parts of adult life. Parents are also involved through loans they took for children, reduced retirement saving, or direct tuition support. The debt may sit in one person's name while shaping the choices of the whole family. The problem is not that education has no value. The problem is that price, completion risk, field of study, labor market outcomes, and borrowing terms vary enormously. A degree can be an investment, but the borrower often makes the decision before fully understanding the downside. Some borrowers pause marriage, children, home ownership, or entrepreneurship because the monthly payment has first claim on future income. Those delays are rational at the household level and costly when repeated across millions of households. An economy weakens families when the path to higher earnings requires debt that blocks the milestones those earnings were supposed to make possible. Buy now, pay later is a newer sign of the same gap. Splitting a purchase into 4 payments can be convenient and sometimes interest-free. It can also make the price feel smaller than it is. The Consumer Financial Protection Bureau found rapid growth in these loans and warned that they have often been difficult for outside observers to track across providers. A consumer can stack several small plans that look harmless individually. The first payment may fit today, while the next 3 collide with rent, utilities, or other installment plans. The product works by moving attention from total cost to immediate affordability. Auto pay reduces missed payments when money is available. When it is not, automatic withdrawals can contribute to overdrafts, declined transactions, or a chain of decisions about which account gets funded first. Retailers value installment options because they can increase conversion and encourage larger baskets. That does not make the product inherently abusive. It does mean the system is designed to help the purchase happen, not to protect the rest of the household budget. The smallest debts are easy to underestimate because they do not feel like traditional loans. Yet 5 modest payment plans can create a fixed weekly drain with no single statement showing the full picture. When families finance clothing, groceries, school supplies, or routine household goods in tiny installments, the warning is not the payment method itself. The warning is that ordinary consumption no longer fits inside ordinary cash flow. Retirement savings show damage that is easy to postpone because the consequence feels distant. The Federal Reserve found that only about a third of non-retirees believed their retirement savings were on track. Many workers do not have a pension. Their future depends on personal contributions, employer plans, market returns, Social Security, and the ability to leave the money untouched for decades. When current costs rise, retirement contributions are among the easiest deductions to reduce. The paycheck gets larger today, but the worker loses the contribution, possible employer match, and years of compounding. Others borrow from accounts or cash them out after job changes and emergencies. That money may prevent eviction or repair a car, so the decision can be rational. The future pays the price for rescuing the present. Older households face the opposite danger. They may own a home and still be cash poor. Insurance, taxes, medicine, utilities, and repairs can force withdrawals faster than planned. Working longer is often presented as the solution, but health, caregiving, layoffs, and physically demanding jobs can end a career before the worker chooses. A retirement plan based on perfect health and uninterrupted employment is not a plan. It is a hope. The economic destruction is delayed but real. A family that repeatedly raids tomorrow to survive today may look stable for years, then reach old age with too little time to recover. Multiple jobs are another visible sign. The Bureau of Labor Statistics counted about 8.8 million multiple job holders in 2025, though annual comparisons require care because 1 month of data was not collected. Some people hold 2 jobs by choice, for experience, variety, or extra goals. But when the second job pays for rent, food, or medical bills, it signals that one job is not producing a secure household income. The extra paycheck has hidden costs: commuting, meals away from home, childcare, work clothes, and unpaid transition time can consume part of the gain. Two jobs also create schedule risk. A late shift at one employer can threaten the next shift at another. A sick child can disrupt both. The worker has more income sources but less control over time. Gig work can offer flexibility, yet the worker may carry vehicle costs, downtime, tax complexity, and income volatility. Gross earnings can look impressive before expenses and unpaid hours are removed. Time poverty changes family life. Parents miss dinners, homework, appointments, sleep, and rest. Partners coordinate through text messages. Children receive less attention not because adults care less, but because survival has claimed the calendar. An economy should not celebrate every extra shift as pure hustle. Sometimes the second job is ambition. Sometimes it is the receipt proving the first paycheck was not enough. Utility stress is another sign because electricity, heating, water, internet, and phone service have become essential to work, school, health, and basic safety. Energy insecurity can mean keeping the home at unsafe temperatures, falling behind on bills, receiving shutoff notices, or sacrificing food and medicine to keep the lights on. The problem is often invisible from the street. Older homes and rental units can be expensive to heat or cool because of poor insulation, aging equipment, or inefficient appliances. The family paying the bill may not control the building improvements that would lower it. Extreme heat makes air conditioning a health need in many regions, not a luxury. Cold weather creates the same reality for heating. Families cannot budget their way out of dangerous temperatures. Internet service now functions like a utility. Job applications, school assignments, medical portals, banking, and government services assume reliable access. Cutting the connection can save money while closing doors to income and assistance. Late fees and reconnection charges punish the household already short on cash. A temporary shortage becomes a larger balance, making the next month harder than the last. When families ration temperature, connectivity, or water to protect the rest of the budget, economic pressure has crossed from inconvenience into living conditions. Delayed adulthood is another warning, though economics is not the only cause. The Census Bureau reported that in 2025, more than half of adults ages 18 through 24 lived in a parental home, as did a smaller but significant share ages 25 through 34. Living with parents can be loving, practical, and culturally normal. It can help families share care and save money. The warning appears when adults want independence but cannot afford rent, a deposit, furniture, transportation, and debt payments at the same time. Marriage and childbearing are also shaped by culture, education, and personal choice. Still, housing costs, childcare, health insurance, and unstable work can make commitment feel financially dangerous even when people want it. The result is a delayed household formation cycle. Young adults stay home longer, older owners stay in place, starter homes remain scarce, and fewer households move through the traditional ladder. Multi-generational living can strengthen a family, but forced crowding creates conflict, lost privacy, longer commutes, and caregiving burdens. The same arrangement can be supportive for one household and suffocating for another. Parents who help adult children may reduce their own retirement savings. Adult children who remain home may provide care or money. Economic strain moves back and forth across generations instead of staying with one person. A family system is being squeezed when independence requires parental wealth. The child of a homeowner with spare space receives a bridge. The child of a renter in a crowded apartment may receive no such option. The final sign is the widening gap between official language and lived experience. An economy can grow while essential costs rise faster than the income of a particular family. Employment can be strong while the job lacks hours, benefits, predictability, or enough pay. The Bureau of Labor Statistics measures inflation across a broad basket. No household buys the average basket. A renter with children, a long commute, medical needs, and high insurance exposure can face a personal inflation rate far above the headline. Averages also hide wealth. Two families with the same income can have opposite realities if one owns a home with a low mortgage and the other rents, if one has relatives providing care, or if one begins the year with savings and the other begins with debt. This is why people become angry when told the economy is fine. They are not necessarily rejecting data. They are reporting a different layer of it: cash flow, risk, time, debt, and the price of essentials in their own zip code. Corporate pricing is part of the story, but not all of it. Supply disruptions, labor costs, housing shortages, interest rates, insurance losses, public policy, market concentration, and consumer demand all interact. Ruthless truth requires more than one villain. The thread is exposure. Families carry more of the risk for healthcare, retirement, education, childcare, housing, transportation, and emergencies. When each system sends its risk to the household becomes the shock absorber for the entire economy. That is what economic destruction looks like before collapse. It looks like functioning households using debt, unpaid care, extra work, delayed treatment, reduced food, postponed repairs, and lost future savings to maintain the appearance of normal life. These 20 signs do not prove that every American family is failing. They prove that stability is becoming more expensive, more complicated, and more dependent on assets, data access, family support, and the ability to survive repeated shocks. The biggest lesson is simple. A paycheck is not security when essential costs can outrun it. A house is not security when it cannot be insured or repaired. Credit is not income. Convenience is not free. And coping is not the same as thriving. Look at your own household and ask where the pressure first appears. Groceries, rent, insurance, childcare, medical bills, transportation, debt, utilities, or lost time. That answer reveals more than a national average ever could. Like this video, share it with someone who keeps hearing that families are doing fine, and comment with this specific question: which of these 20 signs has changed your family's life the most? And what did you have to give up to absorb it?